Stop, just stop. Step away from the charts. We need to pause and breathe before we look at the damage, because allowing the red candles on your screen to dictate your emotions right now is how the market breaks you. I know what it feels like right now. I know the nausea that sets in when you see the spot price of silver collapse from an all-time high of $121 down to $64 in the blink of an eye. I know the panic that grips your chest when gold, the ultimate safe haven, sheds over $1,000 an ounce in a liquidation event that seemed to have no bottom. They want you to feel this fear. They need you to feel this fear. Because this entire week, this historic volatility, this unprecedented 47% crash, and the subsequent V-shaped recovery we witnessed to close the week, it was not an accident. It was not a natural market correction. It was a psychological operation. It was a test of your resolve designed to separate you from your position exactly 72 hours before the rules of the global financial system change forever. It is Sunday, February 15th, 2026. The markets are finally closed, the noise has stopped, and if you are still standing, if you are still holding your physical metal, you have survived one of the most vicious bear traps in the history of the commodities market. Look at the closing price. Silver fought its way back from the abyss to close at $77.41. Gold, which they tried to smash below $4,400, has reclaimed the throne and settled at $541.80. The media will tell you the bubble has burst, the forums will tell you it's over. But if you look at the data, the real data, not the headlines, you will see that the bubble didn't burst. The leverage was flushed, the weak hands were washed out, and the only thing that actually happened this week is that ownership of millions of ounces of physical precious metals transferred from the hands of fearful retail tourists into the vaults of sovereign nations and central banks. We need to talk about what just happened. We need to dissect the anatomy of this crash because it involves a level of geopolitical intrigue and media manipulation that we haven't seen in decades. We need to talk about the headline that sparked the panic. We need to talk about the mainstream financial media. We need to talk about Elvira Nabiulina. And most importantly, we need to talk about why the price of silver in Shanghai is closed $7 higher than the price in New York. But first, we have to address the elephant in the room, the narrative that crushed the market on Thursday. You saw the headline. It flashed across every trading terminal in the world. Russia weighs return to US dollar settlement. In a split second, the algorithms read those words and they sold. They didn't think, they didn't verify, they just sold. Within 20 minutes, $1.4 trillion in market value evaporated. Why? Because the entire bull case for gold and silver over the last 2 years has been built on the de-dollarization thesis. The idea that the BRICS nations, Brazil, Russia, India, China, South Africa, are abandoning the US dollar and moving back to a hard asset standard. If Russia, the leader of this movement, was suddenly planning to go back to the dollar as a peace offering to the Trump administration, then the thesis is dead. If Russia goes back to the dollar, the demand for gold as a reserve currency collapses. That was the logic. That was the trigger. It was the perfect story to destroy the confidence of the gold bugs. It was the perfect story to trigger a cascade of margin calls that would force leveraged traders to puke up their positions at any price. There was just one problem with the story. It wasn't true. It was a phantom. A ghost story. A narrative planted at the exact moment the market was most vulnerable, while you were panic selling because you thought the geopolitical order was shifting. The Russian central bank was preparing a statement that would expose the entire event as a massive spoof. We have the transcripts. We have the direct quotes from Elvira Nabiulina, the head of the Bank of Russia. She didn't mince words. She didn't speak in the vague diplomatic riddles that Western central bankers use. When asked about the Weil report, about the secret talks to return to the US dollar system, she was crystal clear. The Bank of Russia is not taking part in talks on the return to dollar payments for exports. As regards the potential development of relations with the United States, we, as the central bank, are not participating in it so far in any case. The Russian state media went even further, calling the report a Western media narrative designed to destabilize the markets. And that is exactly what it did. It destabilized the paper market. It spooked the paper traders. But did it trick the physical buyers? Did it trick the nations that are actually stacking the metal? Absolutely not. While the price was crashing on the fabricated narrative, the physical buying accelerated. We have to look at the divergence. This is the most critical concept you need to understand to survive in this market. There are two prices for gold and silver. There is the paper price, which is determined by high-frequency trading algorithms reacting to headlines like the one from main media. And then there is the physical price, which is determined by the actual supply and demand for 1,000-ounce bars. When the news hit and the price slammed down to $74 for silver, and $4,400 for gold, did the physical inventory in the vaults increase? If everyone was selling, the vaults should be overflowing, right? Wrong. The vaults were raided. On the very day of the crash, while the world was selling paper contracts, Someone was backing up the armored trucks to the comex in the Shanghai Futures Exchange. We have the data. 5.1 million ounces of silver were removed or adjusted out of the registered category at the comex in a single session. Think about the absurdity of that. The price is crashing, which usually means there is no demand. Yet, the inventory available for delivery plunged below 100 million ounces for the first time in years. We are now sitting at roughly 93 million ounces of registered silver. The shelves are being cleared. This confirms that the smart money, the insiders, the sovereign wealth funds, the industrial conglomerates, saw the media headline for exactly what it was, a discount coupon. They used the liquidity event, they used your panic to buy physical metal at prices that shouldn't exist. They bought silver at $64, they bought gold at $4,400. And now as we close the week, they're sitting on massive gains while the retail traders who sold the bottom are left with nothing but regret. This is the game. This is how wealth is transferred. They manipulate the sentiment to distort the reality. They use spoofing, not just of orders, but of information, to shake the tree. They know that you are emotional. They know that you're watching the 1-minute chart, heart pounding, terrified of losing your savings. They know that when you see a headline about Russia embracing the dollar, you will envision a future where gold goes back to $2,000. But we have to be colder than that. We have to be more disciplined. We have to look at the actions, not the words. And the actions of the Russian Federation, the actions of China, and the actions of the US Treasury tell a completely different story. While the media was distracting you with the Russia fake out, something much more significant, much more tangible, and much more bullish was happening in the United States. Something that media buried, but that we dug up. Scott Bessent, a key voice in the administration's Economic Council, held a secret meeting on Monday. Who did he meet with? He met with Judy Shelton. For those of you who don't know who Judy Shelton is, you need to pay attention. She is not a fan of the fiat system. She is one of the most vocal advocates for a return to a gold standard in modern history. She believes that money should be backed by something real, not just promises and debt. Why would the White House economic team be meeting with a gold standard advocate if the plan was to save the fiat dollar? Why would they be discussing international monetary issues with a woman who wants to peg the currency to metal? This meeting signals that the de-dollarization isn't just happening in Russia and China, it is happening internally. There's a realization in the highest halls of power that the debt is unpayable. They know the fiat game is ending, and they are preparing for the next system. So compare the two stories. Story A, the fake news. Russia is going back to the dollar, saving the fiat system and crushing gold. Story B, the real meeting. The US administration is consulting with gold standard experts to prepare for a monetary reset. Which story aligns with the physical vault drains? Which story aligns with the fact that central banks bought record amounts of gold last year? Which story aligns with the math of a $36 trillion debt pile? Story B is the truth. Story A was the trap. And if you acted on story A, selling your silver at $75 because you thought the world was going back to 2010, you walked right into the trap. But there is an even bigger story than the Russia spoof. There is a structural change coming that makes the media headline look like a children's fairy tale. While everyone was looking at Moscow, the real earthquake was starting in Beijing. We have received confirmation of new rules being implemented by the Chinese government regarding the trading of gold and silver. These are not minor tweaks. These are not suggestions. These are draconian changes to the market structure that are going to effectively outlaw the manipulation games that the Western banks have been playing for decades. For years, the price of precious metals has been suppressed by paper derivatives. Banks would sell contracts representing 100 times more gold than they actually had in the vault. They would rehypothecate the metal, lending the same bar of gold to 5 different people at the same time. It's the fractional reserve method of banking. It's leasing the same apartment to 10 different tenants. It works great as long as nobody asks for the bridge. It works great as long as nobody asks for the gold. But China just said, enough. We are looking at a new regulatory framework that bans off-exchange leveraged derivatives. It bans the rehypothecation of gold and silver. And most importantly, it mandates physical delivery. Do you understand what mandatory physical delivery does to a market that is 100 to 1 leveraged? It destroys it. It burns it to the ground. If you are a short seller in Shanghai and you sold 10 million ounces of silver on paper to drive the price down, you can no longer just roll that contract over next month. You can no longer settle in cash. Under these new rules, you have to find 10 million ounces of physical metal and deliver it. And where are they going to find it? The SHFE inventory is sitting at 11 million ounces. The cupboard is bare. This is why the price in Shanghai is $84.60, while the price in New York is $77. The Shanghai market is sniffing out the shortage. The Shanghai market knows that the paper game is ending. The traders in the East are paying a massive premium to get their hands on the metal now, before the new rules come into full effect. They are front-running the inevitable squeeze. And yet, here in the West, we are still reacting to fake news headlines about Russia. We are still letting the paper price dictate our emotions. We are looking at a $77 spot price and thinking, oh no, it's down from $121. You should be looking at the $77 price and asking yourself if we are witnessing the final days of these valuation levels. Because when these Chinese rules fully hit, when the arbitrage window closes, the price in New York will have to rise to meet the price in Shanghai. Metal flows to the highest bidder. It is a law of physics. If China is paying $84 and demanding physical delivery, and New York is selling paper at $77, every single ounce of silver that comes out of a mine in Mexico or Peru is going to get on a boat and go to China. The U.S. vaults will be drained of physical inventory. And when they are empty, the pricing mechanism on the comex breaks. And if the paper market fails to deliver, the price doesn't just retest highs, it seeks a completely new reality unconstrained by leverage. This is the reality of the market you're trading in today. It is a war zone. It is a battle between the dying paper system, desperate to keep the illusion alive with fake news and leverage, and the rising physical system. The crash this week was their best shot. They threw everything they had at us. They used the media. They used the algorithms. They used the leverage. And what was the result? Silver is at $77.41. It is still up over 100% from where it was a year ago. The trend is broken? No. The trend has just shook off the passengers who didn't believe. In the next part of this report, we are going to go deep into the specific mechanics of the Chinese ban on derivatives. We are going to explain exactly how the rehypothecation scam works and why its removal is the catalyst for the greatest short squeeze in financial history. We will also look at the massive divergence between the official jobs numbers and the reality on the ground. Another set of distorted figures designed to paint a picture of an economy that doesn't match reality. But for now, take a breath. Look at your stack. If you have the metal, you have the power. The paper price is a lie. The volatility is a weapon. Do not let them use it against you. So let's peel back the layers of this rehypothecation scheme, because if you don't understand how the sausage is made, you won't understand why the factory is about to burn down. The new rules coming out of Beijing are not just bureaucratic red tape. They are a declaration of war on the Western banking model of precious metals trading. For decades, the London and New York markets have operated on a system of fractional reserve banking applied to gold and silver. It's a fancy term for a systemic risk, selling promises instead of metal. Imagine you deposit 1,000 ounces of gold into a vault in London. The bank gives you a receipt. You think your gold is sitting there, safe and sound. But under the old rules, the rules that China is now rejecting, the bank can take that same 1,000 ounces and lease it out to a jeweler. Then they can use the lease as collateral to sell a futures contract on the comex. Then they can use that futures contract to hedge a position for a mining company. 1 bar of gold, 4 or 5 different owners. Everyone has a piece of paper that says, I own 1,000 ounces. But if all 5 people show up at the vault on the same day and ask for their metal, there is only 1 bar to give. The other 4 people get nothing. They get a force majeure notice. They get a cash settlement in a currency with strictly diminishing purchasing power. This is rehypothecation. It is the infinite duplication of paper claims on finite physical assets. It is how the banks previously pinned the price of silver at $25. For years, while demand exploded, they simply printed more paper silver to meet the demand, diluting the price. But China has just thrown a wrench into this machine. The new directives make the stance strictly clear. Off exchange, gold and silver rehypothecation is no longer acceptable. This means that in the Shanghai market, and increasingly in the markets that trade with Shanghai, 1 bar of gold can only have 1 owner. If you sell it, you must deliver it. If you buy it, you must take delivery. The paper leverage is gone. The 100-to-1 dilution is gone. Do you realize what happens to the price of an asset when you remove the artificial supply? If there are 100 paper ounces for every 1 physical ounce, and you eliminate the 99 paper ounces, the price has to undergo a massive revaluation to balance the books. It is not speculation. It is mathematics. And this isn't just a theory. We are seeing the panic in the data right now. We mentioned earlier that the comex registered silver inventory has plunged to 93 million ounces. Why are the banks pulling metal out of the registered category? Why are they moving it into eligible or taking it out of the vault entirely? Because they know they can't play the rehypothecation game anymore. They need the physical metal to cover the naked shorts that are about to be exposed by the new rules. They are scrambling to find every ounce they can before the music stops. Look at these specific notices from the comex this week. We saw 1,477 delivery notices for gold issued in a single day. Major institutional bullion banks issued hundreds of notices. The big players are moving significant volume. These are massive numbers. These are banks that usually settle in cash, suddenly desperate to deliver physical metal or frantically trying to source it. This is a run on the bank in slow motion. But instead of people lining up at an ATM to withdraw cash, it is major financial institutions lining up at the vault to withdraw bars. And just like a bank run, the ones who get there first get paid. The ones who get there last get a "sorry, we're closed" sign. The situation is even more desperate in the silver market. The data shows that for the February contract, the demand for delivery is squeezing the available eligible inventory. Think about that. More people are demanding delivery of silver than there are contracts open. The demand for physical metal is exceeding the available paper supply. And remember, this is happening while the price was supposedly crashing. While the mainstream headlines were scaring retail investors into selling, the banks were using that liquidity to frantically cover their own short positions. The price was driven down aggressively, triggering a cascade of stop losses, allowing institutional players to scoop up silver to fill the holes in their own vaults. It is the ultimate sleight of hand. Look over here at the geopolitical tensions. Look at the scary drop to $64. Meanwhile, in the background, they are shoveling millions of ounces into their own trucks. And it's not just the banks. The mints are tightening the screws too. We are hearing persistent reports regarding the UK Royal Mint suggesting they may be actively discouraging large purchases. If you want to buy a single tube of 25 silver Britannias, the price is normal. But if you want to buy a monster box of 500 coins, they are charging you an extra $12 per ounce. Let that sink in. In a normal market, buying in bulk gets you a discount. You buy more, you pay less per unit. That is how wholesale works. But in the silver market today, the logic is inverted. You buy more, you pay more. Why? Because they don't have the silver. They don't want you to buy 500 ounces. They want to conserve their inventory. They are rationing the metal by pricing out the big buyers. This is a massive red flag. When a mint penalizes you for buying their product, you know the shortage is real. You know the infinite supply is a myth. This aligns perfectly with what is happening in China. The Shanghai Futures Exchange is scraping the bottom of the barrel. Their inventory is hovering around 11 million ounces, barely off record lows. And remember the arbitrage? Silver in Shanghai is trading at a $7 premium to the West. If there was plenty of silver, arbitrage traders would simply buy millions of ounces in London or New York at $77, fly it to Shanghai, and sell it for $84. They would close that gap in a day. The fact that the gap persists and is widening tells you that the metal isn't moving. It's stuck. It's either not available or the owners in the West are refusing to sell because they know the price is going higher. The entire global supply chain is gridlocked. The West is drained. The East is hungry. And the paper price often feels like a distortion, maintained by high-frequency trading algorithms reacting to misleading headlines. But the manipulation doesn't stop at the metals market. It extends to the very economic data that supposedly drives the value of the dollar. We need to talk about the jobs report. We need to talk about the strong economy narrative that the Fed uses to justify keeping interest rates high and the dollar strong. Last week, we saw a headline number that shocked the market. The U.S. economy supposedly added 130,000 jobs in January, smashing expectations of only 55,000. On the surface, this looks great. The economy is booming, the dollar is king, sell gold. But just like the Russia story, if you scratch the surface, the truth is ugly. Buried in the footnotes of that same report was a revision, a massive revision. The Bureau of Labor Statistics quietly admitted that they had overstated the previous month's job numbers by over 1 million jobs. 1 million jobs. They told us the economy was adding jobs all year. Then, months later, they say, oops, actually, those jobs didn't exist. It represents a pattern of consistent downward revisions. They release a headline number that excites the market and fits the narrative, only to revise it later. Then, when nobody is looking, they revise it down to reality. The reality is that bankruptcies in the U.S. are hitting the highest level since the pandemic. 9 large companies filed for bankruptcy just last week alone. The rolling average is rising. Corporate America is bleeding. The consumer is tapped out. The strong labor market is a mirage created by statistical adjustments and government hiring. So why does this matter for silver? Because the entire bear case for precious metals relies on the idea that the economy is strong and the Fed will keep rates high to fight inflation. If the economy is actually collapsing, as the bankruptcy data suggests, then the Fed will be forced to cut rates aggressively. They will have to print trillions of dollars to bail out the system. And when they print, the dollar is devalued. And when the dollar weakens, gold and silver fly. This is the macro environment we are in. We have a physical shortage of metal. We have a breakdown of the paper derivative system led by China. We have a U.S. economy that is crumbling under the weight of debt and questionable economic data. And we have a desperate media establishment flooding the zone with distractions to keep you from focusing on the economic reality. It is a perfect storm. And right now, we are in the eye of that storm. The volatility of this week, the crash to $77, was the turbulence before the final breakout. We have to look at the charts again. We have to look at the technical damage and the repair. When silver hit $64 on that fateful day, it touched the institutional accumulation zone. This is the level where the smart money had their limit orders waiting. They didn't panic, they executed. The bounce from $64 to $77 was violent. It was a rejection of lower prices. And now we are consolidating. We are building energy. The inverse head and shoulders pattern that we identified is still valid. The right shoulder has formed. The neckline is waiting at $88. If we break $88, there's no resistance until the all-time high of $121. The path of least resistance now appears to be to the upside. The shorts are trapped. They have used their best ammunition, the fake news, the margin calls, the spoofing, and they only managed to push the price down for 48 hours before buyers stepped in. Think about that. They threw the kitchen sink at the market, and silver still closed the week near $80. That is strength, that is resilience, that is a market that wants to go higher. In the next section, we are going to look forward. We are going to discuss the specific targets for the coming week. We are going to analyze the implications of the Judy Shelton meeting and what a return to a gold-backed system would actually look like for the price of silver. We are going to talk about the institutional signal that flashed when Besant met with Shelton and why it might be the most bullish news of the decade. But before we go there, I want you to ask yourself a question. If the banks are taking delivery of physical metal, if China is banning paper derivatives, if the Royal Mint is rationing coins, why are you worried about the price on your screen? The price on your screen is an advertisement for a product that is out of stock. It is a mirage. The real price is what you have to pay to get the metal in your hand. And that price is going up every single day. We have exposed the fraud. We have exposed the fake news. We have exposed the broken plumbing of the paper market. Now, we need to talk about the escape plan. Because while the media was busy gaslighting you with stories about Russia returning to the dollar, the architects of the United States financial system were quietly holding a meeting that tells us the exact opposite is happening. While you were staring at red candles on your screen, Scott Besant was sitting down with Judy Shelton. If you understand the history of modern economics, the hair on the back of your neck should be standing up right now. Judy Shelton is not just another economist. She is the nemesis of the fiat money system. She is the woman who has argued on the record in front of Congress that the United States should return to a gold standard. She believes that a currency unbacked by hard assets is a moral hazard that inevitably leads to the destruction of the middle class through inflation. And Scott Besant, he is the man tasked with fixing the economic mess we are in. He is the point man for the transition. Media reported this meeting as a brief call. They tried to minimize it. They said it was just about ideas for Fed reform, but we know better. You do not meet with the world's leading advocate for a gold standard in the middle of a sovereign debt crisis unless you are considering the nuclear option. You do not bring Judy Shelton into the war room unless you are preparing to link the dollar to gold. This is the signal. This is the insider move that the smart money is positioning for. The crash to $74 earlier this week wasn't just a liquidity flush. It was a misdirection. While the public was being told gold is dead because Russia loves the dollar, the insiders were preparing for a world where gold is the only solution to the debt spiral. Think about the timing. We just saw U.S. bankruptcies hit a post-COVID high. We just saw the jobs numbers revised down by over 1 million. The tax receipts are falling. The interest payments on the national debt are consuming the entire budget. The system is mathematically insolvent. There are only two ways out: hyperinflation or a reset. Hyperinflation destroys the nation. A reset to hard money saves it. The meeting with Judy Shelton tells us that there are patriots inside the system who are fighting for the reset. They are fighting for sound money. And if they win, if the U.S. moves even 1 inch closer to a gold-backed system, the price of gold wouldn't just stop at $500. It could target $15,000. It climbs to a number as required to cover the M2 money supply. And silver? Silver is the lever. Silver is the restless younger brother of gold that moves 5 times faster. In a monetary reset, silver wouldn't just aim for its all-time high of $121. It tends to revert to its historical ratio with gold. If gold is $10,000 and the ratio is 15:1, where it is in nature, silver would theoretically be valued at $660 an ounce. That is the asymmetry. You are looking at a scenario where the historical upside potential completely dwarfs the downside support levels. It is the greatest risk-reward setup in financial history. And the fact that Besant is talking to Shelton confirms that this is not a conspiracy theory. It is policy in the making. But you don't have to wait for the U.S. government to act. The rest of the world is already moving. While American retail investors were panic selling their silver to pay off margin loans, the eastern whales were swallowing the supply whole. We need to look at India. The numbers coming out of the Indian silver market are frankly terrifying for anyone who is short this metal. In just the last 2 months, Indian ETFs added 36.5 million ounces of physical silver. Let's put that number in context. If you extrapolate that buying rate out for a full year, Indian ETFs alone are on pace to consume 159 million ounces of silver in 2026. That is approximately 20% of the entire global mine supply. One country, one sector of the market, absorbing 1/5 of the world's production. And that's just the ETFs. That doesn't count the jewelry market or the silverware. It doesn't count the solar factories in Gujarat that are ramping up production. India is vacuuming the silver market clean. They are price-sensitive buyers usually. They like to buy the dip. So when the price crashed to $74 this week, do you think they got scared? No. They backed up the truck. They know what we know. They know that paper currency is melting ice. They know that the rupee, the dollar, the yen, they're all fiat. They're all backed by nothing but faith, and faith is running out. Then look at Turkey. We just received data that Turkey imported a record 8.79 million ounces of silver in a single month. Why? Because their inflation is running at 60%. The people of Turkey are fleeing their currency. They are buying silver not to get rich, but to survive. They are buying it to preserve the labor of their lives from being stolen by the printing press. This is the global reality. The West sells paper. The East buys metal. The West looks at media headlines. The East looks at inflation data. The West trades algorithms. The East takes delivery. And this brings us to Indonesia. The news out of Indonesia confirms the trend of resource nationalism that is gripping the commodities world. The Indonesian government just ordered the world's largest nickel mine to slash its output quota from 42 million tons down to 12 million tons. Why? To support nickel prices. Sovereign nations are waking up. They are realizing that they own the real wealth, the nickel, the copper, the silver, the gold, and the West only owns the paper derivatives used to suppress the price. Indonesia is saying, we will not sell our resources for pennies anymore. If you want our nickel, you pay the real price. This is the exact same mentality that is coming to the silver market. Mexico, Peru, China, the biggest producers, are watching. They are seeing the shortages. How long before Mexico decides to nationalize its lithium and silver production? How long before Peru slaps an export ban on raw ore? When that happens, the comex breaks overnight. So, where do we stand right now? It is Sunday, February 15th. The markets are closed. We have a moment of silence to strategize for the week ahead. The price of silver is sitting at $77.41. The price of gold is $5,041. The chart is telling us a very specific story. After the violence of the crash and the V-shaped recovery, we have entered a period of consolidation. This is the right shoulder of the pattern we have been tracking. The technicals have reset. The RSI, which was overheating when we hit $121, has cooled off. The overbought conditions are gone. We have worked off the froth. The market is now neutral to bullish. Here's the roadmap for the next 5 trading days. Support level, $74. This is the floor. We tested it this week, and it held. The bulls defended this line with their lives. As long as we stay above $74 on a daily closing basis, the structure is intact. This is your line in the sand. If we dip to $75 or $76 early in the week, do not panic. That is just noise. That is just the market testing the resolve of the remaining weak hands. Resistance level, $88. This is the ceiling. This is the neckline of the inverse head and shoulders. We need a decisive breakout above $88 to confirm the next leg up. And once we clear $88, the vacuum opens up. There is very little volume traded between $88 and $121. That means the price can move through that zone very quickly. The trigger, the Shanghai arbitrage. Watch the Shanghai price closely. The end of February deadline for the new Chinese hedging rules is approaching fast. We are 2 weeks away. The shorts in Shanghai know this. They have 2 weeks to cover their naked positions before they are forced to deliver. This creates a natural timeline for the squeeze. We should expect volatility to increase as we get closer to March 1st. The psychological game for this week will be boredom. The market makers will try to put you to sleep. They will try to keep the price in a tight range to make you lose interest. They want you to get bored and move your money into something exciting like crypto or tech stocks. It is crucial not to fall for this psychological trap. Boredom is the precursor to the breakout. Accumulation happens in the quiet times. The smart money is using this lull to load the boat before the Shanghai deadline hits. You need to have the mindset of a siege commander. You have your supplies, your silver. You have your fortress, your physical possession. You know the enemy is running out of food. You know their walls are crumbling. All you have to do is wait. The temptation to trade this volatility is high, but this is exactly how the algorithms strip retail investors of their positions. You're picking up pennies in front of a steamroller. In a market this tight, with inventory this low, the gap up can happen at any second. You could go to sleep with silver at $77 and wake up with silver at $90 because a major bank failed to deliver. If you are sidelined when that happens, the opportunity to enter at these valuations may disappear instantly. Trying to enter after the gap up often means chasing the price rather than positioning before the move. We are watching the open interest numbers on the comex very carefully. February deliveries are over 100% of open interest. This is a mathematical anomaly. It means the system is oversubscribed. If the banks cannot satisfy those delivery notices this week, we could see a default. Even a rumor of a default would send the price vertical. And let's not forget the geopolitical wildcard. The fake Russia news was a distraction, but the real geopolitical tensions are still there. The BRICS summit is looming later this year. The de-dollarization trend is accelerating. The central banks are buying. Every fundamental driver that took us to $121 is still in place. The only thing that changed was the paper price, driven by a spoof. So, as we prepare to open the markets for another week of high volatility, remember who you are aligned with. You are standing alongside the people of India who are buying 20% of the world's supply. You're standing alongside the Central Bank of Russia and their 2,300 tons of gold. You are standing alongside Judy Shelton and the advocates for sound money inside the U.S. Treasury. You are aligning with the industrial demand of the solar industry that cannot function without silver. And who is the opposition? You are positioned against a media headline and a paper derivative system showing signs of stress. You are positioned against naked short sellers in Shanghai who are facing stricter regulations. The choice seems clear. The data is compelling. The trend is defined. In the final part of this report, we will bring it all home. We are going to look at the endgame scenarios. What happens when the Shanghai premium breaks the comex? And most importantly, we will give you the final marching orders for your portfolio to ensure you are informed, prepared, and ready for the market shifts that are unfolding. Stay focused, stay disciplined. The best is yet to come. This brings us to the endgame. We have analyzed the crash. We have exposed the spoof. We have tracked the physical flows from west to east. Now, on this quiet Sunday, February 15th, 2026, we have to look the future in the eye and ask the hard question, how does this actually end? How does the tension between a $77 paper price in New York and an $84 physical price in Shanghai resolve itself? History tells us there are only two ways this gap closes. Scenario 1. The physical demand in China collapses and the price drops down to meet the West. Scenario 2. The paper supply in the West runs out and the price rockets up to meet the East. Let's look at the data one last time to see which scenario is more likely. Is Chinese demand collapsing? Absolutely not. We know the solar factories are running 24/7. We know the People's Bank of China is buying gold. We know the hedging rules are tightening to force delivery. The demand is not going away. So that leaves scenario 2. The paper market in the West has to break, and it won't be a polite conversation. It will be a violent snap. We are watching a phenomenon called the arbitrage vacuum. Right now, traders are incentivized to drain every ounce of silver from London and New York and ship it to Shanghai to capture that $7 risk-free profit. We are seeing this in the vault data we discussed, the 5.1 million ounces leaving the comex. But here is the catch. Ships take time. Refining takes time. The flow of metal is slow, but the flow of information is instant. At some point, likely very soon, perhaps before the end of this month, the comex will reach a critical level of inventory where they simply cannot ship anymore. They will hit the operational minimum. When that happens, the force majeure notices go out. The warehouses will say, "We cannot deliver silver. We will settle your contract in cash at the last traded price." This is the moment the game changes forever. If you are holding a paper contract for silver and the exchange tells you, "Here's your $77 back. We don't have the metal." But the real price of metal on the street is $100. You have lost. You have been defaulted on. You got your fiat currency back, but you lost the asset. This is why we constantly preach against leverage and paper promises. In a default scenario, the paper holder gets paid in worthless currency, while the physical holder owns the only thing that matters. This brings us to the most important rule of this entire channel, a rule that keeps us safe, keeps us grounded, and keeps us aligned with ethical, honest finance. We strongly advise against gambling. We caution against using leverage. I see so many people in the comments talking about 10x leverage, options calls, and margin trading. They are trying to get rich quick. They're trying to turn $1,000 into $100,000 in a week. Let me be very clear. The system is designed to kill leverage. The volatility we saw this week, the crash from $121 to $64, was specifically engineered to wipe out people who borrowed money to bet on the price. If you were on margin, you got liquidated. You lost your position right before the recovery. Real wealth is built on ownership, not debt. In our philosophy, money should be honest. It should represent real value, real work, and real assets. When you buy physical silver or gold, or fully backed allocated storage, you are participating in an honest trade. You are exchanging your labor for a piece of the earth. When you trade derivatives with 50x leverage, you are entering a casino. You are betting on the noise, and the house always wins. The Bank of Russia spoof was the house clearing the table. It is best to avoid that table. Own the asset, hold the asset, ignore the noise. That is how you build resilience. Now, we must address the risk. We are not permabulls who refuse to see reality. We are analysts, and as analysts, we must respect the downside. The technical floor is $74. We are currently at $77.41. It is possible, however unlikely, that the manipulators have one more flush in them. It is possible they could push the price below $74 to hunt for liquidity one last time before the Chinese rules kick in. If we see a daily close below $74, the chart suggests we could revisit the head of the pattern at $64 to $60. If that happens, do not panic. If silver goes to $60 in a world where production costs are rising, where mines are depleting, and where solar demand is exploding, it is not a crash. It creates a compelling setup. If you are holding physical metal, a drop to $60 means nothing. You still have the same number of ounces. The weight hasn't changed. The atomic number hasn't changed. The only thing that changed is the number of paper dollars the bank is willing to give you for it. And since we know the dollar is being debased by trillions in debt, why would you care what the bank thinks? In fact, a drop to $60 would be viewed by many as a significant accumulation opportunity. It would be the moment to consider doing what the central banks are doing, accumulating, but the probability of that drop is fading every hour. The right shoulder is forming. The buyers are stepping in at $75. The spring is coiling. So, here are the key action points to watch for the next week. Rule number 1, watch the Shanghai premium. Check the difference between the SHFE price and the comex price every morning. If the gap widens, the squeeze is imminent. If the gap closes because we move up, the breakout has begun. Rule number 2, ignore the spoofs. There will be more fake news. There will be headlines about peace deals, asteroid mining, or gold on Mars. They will say anything to stop the momentum. Verify everything. Trust the vault data, not the headlines. Rule number 3, be patient with the breakout. We need to clear $88. Once we break $88 with volume, the path to the all-time high of $121 is open. Do not get frustrated if we chop sideways for a few days. Consolidation is healthy. It builds the base for the next tower. Rule number 4, look east. The leadership of this market has shifted. New York is no longer the captain of the ship. Mumbai and Shanghai are steering now. We are seeing India buying 20% of the world's supply. We are seeing China banning derivatives. The sun rises in the east, and so does the price of silver. We are witnessing a historical transfer of wealth. It is moving from those who trust in paper and debt to those who trust in physical reality. It is moving from the impatient to the patient. It is moving from the gamblers to the savers. You have survived the crash. You have held the line at $74. You have seen through the lies of the media. Now all you have to do is stand your ground. The vaults are emptying. The clock is ticking on the Shanghai deadline. The era of paper manipulation is ending. Stay disciplined. Stay focused on physical fundamentals. And most importantly, stay true to the principles of sound money. I'll see you on the open.